Sometimes you got to put 20% down. So this gives you an opportunity to potentially buy a rental with 5 or 10% down.
You have a 2% mortgage versus a 5% mortgage, and you didn't have to go through the colonoscopy to get it.
I had a friend who did one of these, and he was negative $200 on cash flow, but the principal pay down was $400 a month. How would you like to have a savings account where you put $200 every single month, and the savings account actually gives you $400 per month?
Their only option is to watch their house go into foreclosure. They lose their credit for 10 years. The most important thing is, because we're still paying on that mortgage, the investor, the current seller, their credit is being saved and actually helped.
How fast can a subject to be done from start to finish?
I've seen them as short as 10 days. We're not having to find a lender that has to get an appraisal. There's no inspections needed. Yeah, for the speed of close, that would be a huge plus as far as subject to goes.
In today's episode, we are going to be talking about how to buy real estate subject to the existing mortgage, subject to existing loans. To help us with that, we have Marcus with Serve First Realty. In today's episode, we're going to be going over the very basics as to what is a subject, what does it mean to buy a home subject to the existing mortgage or subject to the existing liens. We're going to be going over what are the pros from a seller's perspective and an investor's perspective, and what are the cons on each perspective as well too. Who is the ideal seller? Who is the ideal buyer, and what are some of the risks associated with that? Welcome to the show, Marcus. How are you?
Oh, Jose Luis, doing great, man. Thanks for having me on today, bud.
I'm excited about this episode. To be honest, I've been seeing more and more of these happening, and I look back in the 80s, and I believe that in the 80s, these were very common because interest rates jumped up from like 8% to 18% or whatever it was. So people were buying properties with the mortgage in place. So let's jump right into it. What does it mean to buy real estate subject to?
Yeah, well, first of all, great question, because depending on who our audience is, if we're talking to real estate agents or even sellers, it is a new terminology that's kind of been thrown around everywhere. And the specifics is exactly like you said when you opened it up, is we're purchasing the property subject to, meaning with the conditions of the current mortgage. So usually the mortgage is the biggest lien that's in place. So the first mortgage in place, if there's a second mortgage, that one also leaving that in place, and any other subsequent liens that may be thereafter, right? In today's world, we're running into a lot of solar leases that are attached to these properties. So when we're talking about subject to, we're meaning subject to all and any liens that are currently encumbering the property.
Got it. So why would a seller be interested in selling their home subject to any existing liens versus just selling it traditionally and cashing out on their equity?
First off, this isn't a technique or a method that is for any seller. This is typically for a seller either that has some high motivation because they're in some sort of trouble, which I mean trouble being like foreclosure looming or some sort of a divorce coming, something like that with low equity. But if a seller has a home that just needs very little work and turnkey type to get to the market, there's all types of variations of how to sell your property. And what subject to is specifically for those sellers that can't or won't pay real estate fees because they just don't have any equity in their property and they don't want to write a check. It's a method where if a seller is, say, looking at foreclosure and they can't, life circumstances have changed such to where they can't bring things current, without subject to, their only option is to watch their house go into foreclosure, and then they lose their credit for 10 years, and it's a mess. But we have investors coming in, taking these projects these properties subject to, we call reinstate the loan, and then maybe get the seller a little bit of money to get onto the next property, which is usually an apartment. But the most important thing is, because we're still paying on that mortgage, the investor, the current seller, their credit is being saved and actually helped. It's where they could purchase a property a lot sooner in the future when they would have had they gone through foreclosure. So really, subject to is a per seller type of issue, but it works out the best for helping people that really had no other option before they ran into subject to.
Would you say that a good portion of the sellers who are selling subject to have very little equity in a property, where if you pay a 6% or if you pay a 5%, it almost eats up at your entire equity or whatever equity you have. Or in some cases, instead of having equity, once you factor in a 5% commission, you're actually negative on the equity.
That's the main. So we're seeing it on both sides of the spectrum. We have sellers that are just, for whatever reason, they have to sell and they just don't have the equity right now. So this is the fastest and best way for them to get on to whatever's next in their life. And they have to take the good with the bad. We'll get into that a little bit later with the pros and cons, but we got to take the good with the bad, like everything in life, because we have to make this decision right now. We have to give up some of these other things that we prefer not to have in place, but they are. So it works on that spectrum. And then subject to also works for the spectrum of let's say there's an investor landlord out there that's had a property for 25 years and their equity is basically 100%. They have zero mortgage or a very small mortgage on the property. And then we can still take over that subject to mortgage, which is a very small mortgage. But then we can pay that seller in installment payments on their equity, therefore alleviating them from having the capital gains taxes. And only an investor that knows creative financing can present that to a seller that is looking to pass off, 1031 exchange, so to speak, but to not have to pay their capital gains right now. They don't want to have to go through the problems of a 1031 exchange. So we help out both sides.
The other thing I was going to say, it could also be a solution for speed as well too. So like, let's say that you want top dollar, right? And or not. Let's say that you want a certain price, and if let's say you need to sell in 7 days, you can either sell to an investor or a cash guy that is going to buy it in 7 days, but the cash people are typically going to want to pay a discount basically because they're cash. Or another option is selling it subject to. How fast can a subject to be done from start to finish? Meaning from the time you enter into an agreement to the time it closes, and why can it be done so quickly?
I've seen them as short as 10 days, and then as long as about a month. And all of that determines on getting back paperwork that's needed in escrow. So the escrow company is going to need to get the estimated payoff of the mortgage that's going to be in place. We have to get any kind of HOA docs that may be needed. We have to make sure there's a clear title on the property. But once those three conditions are met, we can close because we're not having to find a lender that has to get an appraisal. There's no inspections needed, all of those type of things. And a savvy investor is going to walk through that property first off and be able to see what they need to do without having to have a contractor come back in 10 days or whatever it may need to be. So yeah, for the speed of close, that would be a huge plus as far as subject to goes. But it's once again, we're at the whim of the institutions that have everything, because it doesn't come back quickly where you got to get a payoff from the bank, or you have to get the HOA transfer docs, or clear of title can take 3 days, can take 10 days. It's very strange. I'm not a title guy, so I don't know enough about that to understand why some come back so quickly and others don't, but it's all good. I don't want to get too deep into the weeds on that kind of stuff.
So basically, in other words, you don't have to qualify for a new loan if you're the buyer, which means you don't have to go through the loan process. You don't have to worry. Like if you're selling above market value, because you have to do, let's say that you have to pay some realtor fees and you're selling it above market value, you don't have an appraisal either on the property, which makes it so that no appraisal, no loan process going on in these types of transactions.
That is exactly what we can offer the sellers. And let's say the seller wants market value, but they know their property needs work and all these other type of things. Like you said, the cash guys are going to come in and undercut them, tell them, hey, we need $80,000 worth of work on the property, and I got to undercut you this amount. Because we're able to space out payments and pay the seller into the future, we can give them what they want, their number now on creative finance side. As far as subject to is a type of creative finance, but when you're putting together a financial creative deal, it's pretty much between the investor, who's the buyer, and the seller, and whatever terms work out best between them all. The best part about it, yes, is as the buyer, the subject to buyer, is we're not going to any bank, we're not going to any loan officer and asking them to, with your hat in the hand, can I get approved for this mortgage? We're not assuming the mortgage. Don't make that assumption. We're not talking to the lender at all, letting them know that somebody else is going to be essentially making the mortgage payment. That is just done in paperwork that's at closing. and then we just have a lot of things that are done post closing in TC work that helps the seller and the buyer put these two things together.
So let me ask you this. What's the benefit to the buyer? We've talked about some of the benefits to the seller, that they can sometimes sell above market value. They can basically sell pretty quickly as well too. They can sell above even the appraisal if needed, because there's no appraisal. What are the benefits to the buyer for wanting to enter into something like this?
The first thing we actually, for both sides, is the speed of the transaction. As a buyer, most times, as an investor specifically, because usually one's doing these types of purchases, you have an exit plan already planned for this property, and the speed is the better. What is the saying out there amongst investors? Time kills deals. And when you're taking 30 plus days to close a deal, your prospective buyer may have found another 2 deals to go buy rather than your deal that's taking 30 days to close on. So from that aspect is a huge, you don't have to get approved. You don't have to go through all of those things. You will typically, as a buyer, on a subject to, you'll probably have to come up with less cash out of pocket to actually get into the transaction than you would have to go to a bank, because the bank's going to want 20 to 40% down for your investment property. And then the biggest one that we all love about subject to is we're coming out of this season where we had 2 and 3% interest rate mortgages. So, if we can, as an investor, come across a 2 or 3% interest rate mortgage, that's the cherry on top. Is the advantages. Now, if you have to go to a bank, you're looking at 5% best with the buy down. And now we're looking at 2 or 3% with a long-term mortgage that's still got 24, 25 years on that mortgage.
And then the other thing is, they don't have to go through the traditional process of qualifying for a loan. I'm imagining they don't have to go through the underwriting process or the colonoscopy, I would say.
No, you're exactly right. No, we don't. That's when I discovered subject to almost 5 years ago, I was dumbfounded, and I was just like, "There's no way this is real. There's no way," But then after being around it all this time, and now being on that side of the fence for so long, I can't see how other people can't see how it's not real.
Not only that, but this, if you look, it was funny because a client, I was looking into a property that he's considering selling, and he sends me the original purchase contract, a 1-page agreement back from the 80s. And it said on there, buyer is buying the home with the existing mortgage in place, subject to the existing mortgage. And then it gave all of the details of the existing mortgage, because at that time, the rates went from 8 to 18%, which is a very similar environment that we have right now. Obviously not to that extreme, but they went from 2-3% to 8% in a matter of a year to 2 years, basically. It's a very similar environment where when that happens, and if somebody bought at a certain time or refinanced at a certain time, they just don't have enough equity to be able to sell at the price that they need to, but they may have a good loan in place, and this is potentially a solution to them. So let's get into some of the risk associated with the seller. So obviously, it's not an assumption where the buyer is qualifying for the loan or taking over the existing loan by notifying the lender. What are some of the risks to the seller of doing a subject to transaction, or of allowing somebody to take over their payments, because technically the loan is still under their name?
Correct. Yeah. Like I alluded to earlier, this isn't for every seller. So that is the highest risk right there, is just what you mentioned, where it doesn't sit well with any of us to have a loan in our name and then allowing somebody else to make those payments in good faith that they're going to do that and not default or somehow steal our property. And with this being, like you said, this has been something that's been going on in the 80s, and even before that, like before there were real estate laws and everything else, people were trading properties about, hey, this cost me 50 pieces of gold to build this property. I'll allow that to stay in place. You just make me monthly payments on it. They were doing this forever. So the advantage of this and the disadvantages have always been the same, as far as you have to have built that trust and rapport with the initial buyer of your property, because you're leaving your name on that very important mortgage that's out there for a huge amount of money. The second risk, I would say, is you have a what's called the alienation clause or the due on sale clause out there, which is the big bad due on sale clause. And that's really the only recourse the bank has for if you trade your property without paying off your mortgage, because that's part of the purchase agreement that you signed with the bank. Well, the only recourse they have is with the due on sale, and they just basically what they'll do is send a letter saying, "Hey, we see that the name on the deed is no longer the person on the mortgage," and they give you an opportunity to remedy that fact. If not, they will call the loan due, and they'll give you 60 to 90 days to get all that done. Not as scary as it seems. Being in creative finance for long enough now, we have ways to reverse it, and and everything's back to normal, and nobody's scared or the bank's none the wiser. Lastly, I'd say the biggest risk is, and I don't even know if it's a risk, but people can see it as a risk, is what happens if I have to take this property back, the seller. And, you can look at it as a burden, or typically people that are doing these subject to transactions are investors, and they're doing this for a reason. They're putting money into the property. They're improving the property. They're getting the property past whatever malice it had in order to reason why we had to do the subject to transaction. So most point, people think it's a risk as far as the seller saying, "Oh man, what if I have to take my property back?" You're going to probably get an ugly penny all shined up right back. You may have to spend a little money, whether you have to enforce what's called the performance deed. And we can get into that a little bit later. Or you may have to do a traditional, we'll call it a foreclosure, but basically you're going to have to take the seller to court, take the buyer to court, remedy the arrears on the mortgage, and then make the new buyer put the property back in your name without having to go through foreclosure processes. Because really, unless the bank has started the foreclosure process on the original seller, you can't really foreclose on the subject to buyer, because it's not your mortgage, it's the bank's mortgage.
So for people to understand this, if I'm taking over somebody's mortgage, does a title transfer over to my name if I'm the new buyer? And is there only one way of doing the subject to transaction where the title transfers over to my name? Is there a way to do a subject to where the title stays under the current seller in that situation? And I'm imagining that most buyers wouldn't want to do that, because then if the title remains under my name and I get a judgment on the property, then that is tied up to the property now. So is that the only way of doing it, where the title gets transferred, or are there different ways of structuring the transaction as well?
Oh yeah, there's multiple ways of structuring it. Mostly we judge upon the comfort level of the seller. If we're talking to a seller that's just completely against leaving that mortgage in their name and having the deed put in somebody else's name, you could still do a contract, or basically we call it like a land contract, where deed and mortgage still stays in the seller's name, but you have the new buyer has equitable rights to the property. So you still have, you get any equity, any kind of forced equity you put into it. I mean, any number above your agreed upon contract price will be yours, just because you have equitable contract. You can sell the property, but it's just everything is going to be still in that seller's name, because you'll just have equitable rights. That's the first way to keep it just kind of clean. But once again, on the investor side, you do have a little bit of higher risk, because you got to trust that seller now, right? That they're actually making their mortgage payments. And there's a lot of things that go on there that, once again, it has to be a mutual trust, because, hey, look, I'm allowing us to not take on the deed, because as you know, there's a mortgage and a deed in place on your property. You can separate the two and still and do a transaction. So if that seller is not comfortable with separating the two, us as the investors, we have to find a way to protect us a little bit more. And that would be, for a certain time frame, you'd have to hold back some amount of money in escrow and have that money released on an incremental basis to keep that seller truthful. What we're finding, because all this is just money, right? Everything's related around money with these transactions. So if someone's still expecting some money to come, they're still going to be playing nicely with the transaction. If they get paid all up front, then the probability of them not performing the way they said they were going to perform just goes up a little bit higher.
So basically, in the land contract, which means it's almost like a subject to, but the title remains under the current seller, probably leave some money in escrow to make sure that the seller is performing. And then if the seller's performing on everything that they're saying, then at that point that can either be dispersed in payments or a big chunk.
It'll be escrow instructions, but yeah, usually it's quarterly. We kind of look at it quarterly, and then they just disperse quarterly to try to pay them off in that first year, and well, not pay them off, but get the initial whatever the down payment was, so to speak, on the contract to get the seller okay with where he's at. We would need to space that out just to make sure it's right, and then usually those land contracts are going to have some sort of a shorter, what we call a balloon, to just get that loan out. And when I'm doing this as a TC, if I see someone that's just trying to get a deal done, and it happens a lot, and they want to do a land contract because the seller is absolutely against putting everything in their name, it's really not worth it if you're looking at a mortgage that's like 2 or 3%. If you're going to have to balloon them out in 2 years, you don't know what the rate's going to do exactly, and it's more likely you're just doing it just to do it. So there are lots of options out there to do things with creative finance. There's just tons of ways to take properties and to take possession of a property, but you probably shouldn't do every single one that you can do. Not every time is it a deal.
What type of due diligence would a buyer need to do to make sure that like they're getting into a situation that is right for them, basically? And then also, like, let's say you were a seller, what would be your process? Like, let's say you were a seller and you were selling a property subject to what would be your process to reducing some of the risk associated with it, basically, if we didn't want to do a land contract and it was just subject to?
As a seller, I would be doing my homework on my prospective buyer. Typically it's an investor, so they're usually going to purchase an LLC. So my first question is, how many times have you done this in the last year? Do you have any examples of this? Who's your title company that you like to use? Just ask them questions about the team that specifically, because now once I get into the side of the buyer, should have, if you're talking to a professional. And in this day and age, like you said, we're getting into where the market has shifted. So more and more people are coming out of the woodwork with this terminology, but maybe they don't have the experience behind them. And that's where it really is on the seller to do their homework, just like they would anybody. I want to see some experience behind you. How many times have you done this? How come I can't find you on Google? All those questions that a typical seller would ask, even if they were to find a real estate agent, really. I bet you they do more investigating to find a real estate agent versus when they find an investor. And it's typically because people, when they find an investor with these types of transactions, they're in trouble. They're either about to lose their house or their credit, or they don't know how to they don't know how to transfer a property from their from the deceased relative into their name, so they can't sell it and get the proceeds from it. So there's a lot of reasons out there that would be advantageous for a seller to use this, and then it's just on them to do their homework, because anybody they're talking to on the other side of the table is gonna, just that first date syndrome, gonna present themselves in the best light. Now, as a buyer, first thing I tell everybody that brings me a contract when I'm TCing their contracts is, I'm like, what's your exit strategy? My first question. I mean, and every buyer, as an investor, or even if it's a homestead buyer, what we call, so an end user, that's my exit plan, is I'm going to move in my family. Okay. So, we say first, have your exit plan. Secondly, as a buyer, are you financially worth it, or worth standing to be able to purchase this property, or should this be a transaction that you maybe sell to another investor and just make some more money on yourself? That way you have some deeper pockets to actually start holding properties. That's the second question we ask, is along with your exit strategy. Let's say if your exit strategy is to hold it and put a renter in there, well, that second question is, do you have enough money in your bank to withstand 3 months of mortgage payments? And then that's the next question we ask. So where we're coming from with all these questions is, from my side at least, not everybody does this, but from my TC company, we want to make sure that everybody's going to be in a better position at the end of the transaction than they were at the beginning of the transaction. And a lot of times that cannot be the outcome, because somebody has put themselves in a situation, say as a buyer for a subject to, where they're helping out the seller, and the seller's super excited that they helped them out. And now that subject to buyer is lost as far as what to do now that property is in their hands and they've closed on it and they're super happy. And now they're like, what next? And now you have not only yourself but another person that is counting on you to do what you said you're going to do as the buyer. So, rapport, but not only that, but integrity is huge, and the community that I'm part of, subject to, that's some of the things that we try to rely on is say, hey, look, we're part of a private community, so we can have trust and integrity between each other and make sure that we're at least between each other doing the right things, and then trying to educate everybody else after that, and myself, I work with other investors rather than subject to as well. So, but for the buyer, it's mostly integrity type of things and financial withstanding to make sure that you can do what you said you're going to do with this property.
What would be like a buy box like that most subject to investors look for? Meaning like low interest, low equity, like maybe does it has to cash flow, I'm imagining, unless you're using it as a primary.
Yes and no for your last question, but you've got multiple. As an investor is going to buy a property for multiple reasons. They're going to have it for appreciation, depreciation, cash flow. Appreciation, depreciation, play down. That's it. There's 4 reasons. So if one of the 4 is not in place, it still might be okay. And with subject to right now specifically, because the mortgage rates are so high, it's really the only way in our state, California, to actually cash flow on a new purchase right now if you're going to rent that out to at market rates. Market rents are below right now what new mortgages are at for that same price point. Really, for an investor to be able to, as a long-term buy and hold investor, to be able to kind of realize any kind of cash flow, you have to seek out those low interest mortgages right now. Whether the equity is high or not doesn't really matter. We got to look at the low interest rate right now in order to get the cash flow as far as the monthly cash flow goes. Now, pay down can be there, and that's fine. That's going to be with any renter. So you're looking at pay down, and then if an investor has enough passive income that they need some depreciation on the property, they might not need full cash flow, but at least full coverage, full debt coverage. Not negative cash flow. I have heard of a few guys taking a hit negative cash flow wise for like the first couple of years because they can see the appreciation in that market will outpace their loss. So they can see that if it's above a 10% appreciation in any kind of market, you can take a little bit of a loss in the first year or two, and you'll gain that back. But really, it's if you're an end user, it's a great way just to get yourself into a low interest rate. If you're looking for a new house for yourself and you have this kind of knowledge, or your agent has this kind of knowledge, to go seek those type of properties where you find someone's in trouble with a low interest rate mortgage, and you can save some money on a down payment, or maybe make a little bit bigger down payment, but you have a 2% mortgage versus a 5% mortgage, and you didn't have to go through the colonoscopy to get it. So yeah, it might be worth it.
And that's the thing, like to buy a rental, sometimes you got to put 20% down. So this gives you an opportunity to potentially buy a rental with 5 or 10% down. And also, like you said, appreciation, you can get depreciation. So there's other benefits associated with it as well too. I had a friend who did one of these, and he was negative $200 on cash flow, but the principal pay down was $400 a month. So the way he explained it to me is, how would you like to have a savings account where you put $200 every single month, and the savings account actually gives you $400 per month? And I was like, oh, that's actually a pretty good idea, right? Because it's like you're basically, the principal's getting paid down. So let's talk about a performance deed. What is a performance deed? How does it work? Who does it protect? And
Yeah, no, it's performance deed, something that was coined in the creative finance world. Essentially, what it is the banks allow, if you're going in foreclosures, a lot of lenders allow the mortgagee to do what's called a deed in lieu. So essentially, you're giving over your property in lieu of going into foreclosure, and you're signing the deed back to the bank. Well, in a creative finance transaction, what we can do, and what we do is we have a deed in lieu pre-filled out. The buyer has it signed, but the seller has not signed it. And then if the buyer defaults, which is whatever the terms are mentioned on the promissory note that the seller and buyer come up with at the time of the transaction, because that can be anything. But and when that default happens, we use a third-party servicing company to take all these mortgage payments every month, just like everybody else. Everybody pays their mortgage payment to a servicing company that disperses money to all these different accounts. Well, when we're setting up these transactions, we do the same thing. We set up a servicing company. That servicing company knows if you're making your payments or not as the buyer. Well, if you breach the terms of the promissory note and the deed in lieu or the performance deed is then triggered, what happens is the servicing company has the right to then send that deed in lieu to the seller. Seller signs it, records it, and now the property has been redeeded back to the seller out of the subject to buyer's name. So that takes care of the front end as far as the new buyer that has defaulted having no more ownership of the property. One thing we still have a problem of is if we gone 2 months behind it without making a payment, which is typically we have on these performance deeds, so we don't trigger the notice of default at the bank level. Now that seller that got the house deeded back to them, they have 2 months worth of mortgage payments they got to catch up. So we always just got to keep those things in mind when we're talking about security instruments. The other thing about the security instrument is there, but the reason why the security instrument was put in place is because now there's a monetary negative amount somewhere that has to be taken care of. It has to be cleared up. So the performance deed is great. It gives the seller a good amount of cool. If you fall off the planet and stop making payments and I can get my property back, okay, cool. I don't have to go through foreclosure. I don't have to pay a bunch of these lawyers, a bunch of stuff. Great. Unfortunately, if and we know as professionals, we do a lot of transactions. Not many of them go to court, but if it does go to court, typically a judge is not going to accept a pre-signed deed in lieu, basically saying like, hey, in case I do screw up, here it is. They're not going to allow that. So they'll basically undo the transaction back to the seller, giving him back to where he was in whole before he met you, Mr. Buyer, that went and defaulted on him, even though you said you weren't going to. And you, the buyer, will now have that financial responsibility to make the seller whole through some type of retention or getting sued or whatever is going to be through the court. But it's still protection for the seller. Just if it has to go to court, it gets a little bit more messy.
Basically, when you say messy, it means that it would likely not hold up in court, which now at that point, it just becomes messy. Basically, it's kind of like
everything. Yeah, I mean,
it just becomes a mess. Basically, you've got a property that you no longer own, where the buyer is in foreclosure. Basically, litigation is not a fast option, so you've got multiple things happening at one time. The right thing for the investor who's behind on their payments would be to say, hey, you know what? I messed up. You're right. Here is the deed back to the property. 60 days into it, that performance deed would kick in, basically. So that would be the right thing to do. But obviously, that's some of the risk associated with it. But that performance deed is put in place to potentially redeed the property back if a buyer gets behind 60 days or more. There's more to that that we can talk on a future episode. What I was going to say is, here's a risk as well too. Let's say that the bank calls the due on sale clause. For whatever reason, they call the due on sale clause. You mentioned earlier about reversing the due on sale clause. What did you mean by that?
A couple different ways, but depending on state where you're at, but you can do a couple different things. Essentially, you're just redeeding the property back to the seller. So you just go back to escrow and you're basically signing a quick claim, deeding the property back to the seller's name. Okay, and then you record that, and then you show the bank that, hey, look, the seller's back on the deed, and that will remedy that with most 99% of the banks. Another time we could do is, to finish that up, what we do is we redeed it back to the seller, and then we put in place a lease option. So we say, okay, well, we're still taking control of the property through a lease option. Here's our terms of the lease option, and we will express our option X date, whatever the balloon payment was, if there was one on the original contract. Okay. In that same light, deed it back to the seller, do a land contract. So an equitable interest contract, both of which can be done quickly. The same day you open escrow, you can go get these things done and have it recorded probably the next day. Because during that due on sale clause, the bank gives you 60 to 90 days to remedy any of these issues that are happening. Okay. And now the last one, because it's the reason why we're taking over these properties subject to is because of the interest rate on these mortgages. But the last remedy for it is just to refinance the property into a new mortgage in your LLC's name or your name, whatever the investor's doing. Now just pay off the bank and get them out of the way, so you don't have to even worry about their due on sale clause. But really, in today's market, that's not advantageous. You might as well have just gone out and purchased any property you wanted to buy with an investor loan.
So there's no sense of overpaying for that. What happens if, like, let's say a seller does a subject to transaction, they find the buyers in it, then the seller gets mad and then notifies the lender of the due on sale clause. Obviously, they're not acting in good faith at that point. Does that ever happen where they do that? And what are some of the remedies to that buyer?
Yeah,
Or is that where that trust factor comes in?
The trust factor is supposed to come in there, and it hasn't happened to anybody I've directly worked with, but stories through subject to and even Pace in the community is that it has happened so many times in the past that we've added it into the new contracts that we're actually using, stating that, and the seller signs it. It's a disclosure that if the seller goes around the buyer's back and notifies the bank of this transaction in hopes to get the due on sale clause called, we have the right to take them to court for $50,000, and they sign it. Once again, you have to spend some money out of your pocket to get that. But like every other contract, it's a deterrent. Everything in this world is a deterrent to have people do the right thing. Now, in the bigger scheme of things, you can't control what a seller does and what someone's going to do. And if they're going to call the bank and rat you out, so to speak, that you've taken over their property and you stolen their house from them and they're in dire straits and all these other things, you can't control that, and then you have to exercise one of those options that we talked about just a minute ago.
What are the main things that trigger that due on sale clause? Like, meaning, let's say that the seller is not the one that says something. What are the things that trigger it, and how can both buyer and seller protect themselves on that?
Gotcha. Yeah, there's one big one that always comes up is insurance. And a lot of people have overlooked it in the past, which is why we focus on it so heavily now as a transaction coordinator. But the homeowner's insurance has to be placed in such a way that the investor is also protected, but the original seller, whom is on the mortgage, still has to be named on that policy. And every year when servicers and lenders go through their book to make sure everybody's still covered with their coverage, if they see that the policy doesn't match the deed, that's a quick one right there. And that's something that banks do on a regular basis, whether it's quarterly, twice a year, once a year. That is something that is done on every lender, to make sure that their assets are being insured. So that's the first way that typically something like this comes up. The other way, like we talked about, is the seller, if they were to go around and take this out. And the third most obscure way is if you're using a small hometown credit union and the original transaction was done at that credit union, and the same person is looking at this new transaction and like, hey, wait a minute, I remember this address. I did this 5 years ago. Wait a minute. And they go back to the paperwork and they see that, wait a minute. And they can and they'll actually look at the contract because it's a small bank. Now I haven't, but once again, in the community, we've had examples of this where the actual president of the bank was underwriting every transaction, real estate transaction. And he saw an address that he had recognized, whatever, I don't know how, whatever it was, familiar with it. And then he dug into the purchase contract and saw that it was a subject to purchase, and they called the due on sale clause. The bank has the right. They don't have the obligation to. But the promissory note that we sign with the bank when we have our mortgages and all the stack of paper that we sign when we buy our houses with a mortgage, stacked in there is a clause talking about where if you transfer the deed out of your name, that you need to pay off the mortgage within X amount of time. And within that verbiage, it doesn't say the bank is obligated to. It says the bank has the option to express and call forward the due on sale clause or alienation clause. So it's really at the bank's discretion, but it's not something that happens very often. We do focus on it a lot more as far as even just in conversation and practice than it actually happens. It's probably like a 1% type of thing, which is even going to get lower if we keep our P's and Q's correct with our insurance. And even HOA can once in a while cause a little bit of a problem if the HOA reaches out to the lender, but most times HOAs aren't that savvy to do that. But yeah, it has there's not too many ways that the due on sale clause could be called. And once you've seen it a few times, it's not that big ugly beast that everybody thinks it is either. It's nothing big.
How do you protect yourself if insurance is one of the biggest reasons why it happens? What's the workaround?
Oh, you just get a new policy. You can get like what's called a landlord's policy if you wanted to. And typically, an investor that's doing these subject to transactions they're purchasing these properties in an LLC. So we have the LLC named as the head insured, and then the additionally insured as the original seller. And so that policy is sent forth into the new lender. They see the original mortgagee is still on that policy, and in the bank's eyes and in the lender's, in the insurance company's eyes, is now this seller is renting out this house, and he has put himself in an entity, and now that entity is owning the property, which is renting it out.
And that's what a lender would look at. If they see an LLC, they're like, oh, this person just basically, unless they do like homework and like see who the assigned agent is. And
yeah, they have to do it.
So it would probably be better to put it under an LLC versus putting it straight under your name as an investor, because at that point it becomes pretty obvious if it's an LLC. I have properties and people have properties all the time that they put into LLCs. Is there any advantage to putting the LLC name the same name as the last owner? Like if the last owner who sold it's John Smith, making it John Smith LLC, is that even a thing? Or
I've never heard of that, but I'm sure that would be because a lot of people do. They'll put like their last name as an LLC or whatever. So
or just putting like at the name of the previous owners Gonzalez, putting it Gonzalez H Street LLC.
We can go through that all the time because every investor has a different taste for how many LLCs they like to have and what they're going to put in those LLCs and all that kind of things. But yes, essentially you could.
Yeah. What I was going to ask you is this, like, and I don't know if this is true or not, but let's say that I sell my property subject to the existing mortgage or subject to all the liens. Can I buy a property in the future? And because I still have the existing mortgage, or can I not buy it because I have that existing mortgage that is not under my name? And if so, what's the proper way of what's that lender likely going to ask? I know that you're not a lender, but maybe you know this.
No, we've run into it because we've just had people going along for this long. Yes, you can purchase a home in the future if you're a seller that sells your home on a subject to mortgage.
As long as you qualify, basically.
As long as you qualify for your next mortgage going forward. Part of that qualification will be what's called the debt to income ratios. Okay. And we would need to work. So once again, the seller would need to still have a good relationship. Doesn't have to be an everyday relationship, even more than once a year, nothing like that, but just have a good rapport with the initial buyer, the investor, because you're going to have to go back to them and say, can I get a report or a printout from the third party servicing company to show that you have been making the payments since this date that we sold the property? And that way, that person, that seller who was trying to be a new buyer now, takes it into their loan officer to show they're no longer responsible for payments on the property that their mortgage is on. That underwriter will then take a percentage of that DTI, of that mortgage payment off of their DTI going forward. Percentage is determined by how long the other third party has been making the payments on the property. So I believe for the first year, most underwriters will allow 75% of that mortgage amount to come off of your new DTI. So they'll allow that to come off. So let's say if it's, just make things easy, if it's $1,000 a month, they'll allow 750 of that to be counted towards your new mortgage, and only hit you up for the $250 a month as far as on a debt. Now, after year two, most underwriters will allow you to have 100% of that mortgage payment written off of your debt, and so to allow you to get fully approved for the new mortgage amount, not worrying about the past mortgage amount. No different than if you were renting it like a landlord.
And it's no different than like a lot of people co-sign on cars. And when they co-sign on a car, basically it comes up on their credit report. And a lot of it, if you want to get that not count against you, a lot of it has to do with who's making the payment. And if you can prove that somebody else is making the payment, which is kind of the same thing as this subject to that, if you can prove that you haven't been making the payment, somebody else has been making the payment, then they can, underwriters will likely use that income to help you qualify. Obviously, that's the importance of having a servicing company in place, basically, because I'm imagining that without the servicing company, that it's not that easy, basically, to prove that somebody else is making the payment versus if there's a servicing company in place as well.
Can be done, but now you're asking people for favors, right? And hey, I need a favor. Can we put together this ghost lease to show this and blah 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 blah? So we don't want to do that.
Yeah. Now, let me ask you this: like, how long do these subject to transactions typically go for? Let's say that I bought a property 2 years ago. I sell it subject to the existing mortgage. There's 28 years on the loan. Is the buyer typically buying it with that 28 years in place? Is there typically a balloon after 5, 10, 15, 20 years? What does that typically look like?
I'll start with typical, and I'll tell you what we typically do. So what typical is right now is about 10 years. Everybody's signing these 10-year balloons. So like, oh, the sellers are comfortable leaving this in their name for about 10 years because they're in whatever position they were in. Well, I will tell you, when I propose every transaction that I propose to as an investor buyer, I prepare that seller for me to leave that mortgage in place for the life of the loan. And I say it just like that. When they ask me, well, how long is this going to be in place and my name's still on the mortgage? I say, well, for the life of the loan. And, I just hold my tongue. Because that's the expectation. Is the reason I'm taking this mortgage over subject to is because it has a mortgage rate that's favorable.
2-3%, basically.
2 or 3%. And it can be all based upon that too, right? Say if you have a subject to mortgage that's in the maybe high fours or mid five, maybe you can do a shorter time frame on that because you know that hopefully sometime in the future that the market will come back around to where if you have to refinance it through a traditional bank or even a non-QM loan, that you can go do that and hold to your obligation to get the seller out of their position. But if you're savvy enough as an investor, know and have a good rapport and know your stuff in and out, after that 2 years, it really shouldn't matter to the seller if they're still on the mortgage or not, because it's not counting against them. It's just helping their credit.
So it's indifferent, basically. And then if I'm understanding correctly on a subject to transaction, I'm making the payments to the servicing company, and that servicing company is making the payments to the mortgage company, to another servicing company.
Right? Yeah. One servicing company paying another servicing company. The good thing about it is the subject to buyer is only paying that servicing company for one payment. And then they're paying the other servicing company, which is dispersing the taxes and the HOA if there is one, and the escrow accounts and all this stuff.
If I'm a seller, why wouldn't I just rent out the property versus doing like a subject to?
Toilets and tenants, right? Like when you're a landlord, man, your toilet breaks, you're there. When you lose a tenant, you got to get a new one. There's still a lot of touches on that property where most times subject to is being done. Let's start on the lower end spectrum, because I did mention two ends of the spectrum where subject to takes place. So the lower end of the spectrum, the subject to, the people that are in financial straits, there is no opportunity for them to wait 1 or 2 months to get the renter in there and take the risk as if the renter doesn't even pay the payments and now he's a squatter and can't evict them, especially in our state where we're at. So there's a lot of higher risk with being a landlord. Not everybody wants to be a landlord for those two reasons I mentioned, tenants and toilets. Maybe not even prepared for it. So a lot of the rebuttal that we first get mostly from agents when we're presenting it to homes that are listed on the market is just that. If they wanted to do that, they would just rent the property out. And then I firstly say, okay, so do they have experience managing properties? Do they have, you get into that. But yeah, that's the main reason why they wouldn't do it they're not landlords, they're not investors. Now, on the other side, when we're talking entire landlords, which is usually why someone will sell a subject to, they got a very small mortgage in place. They don't want to pay capital gains on the big equity that they're having. And they trust a savvy investor that's experienced, and he's paying multiple other notes off, and they can see that through the HUDs. So therefore they have confidence that this guy's going to pay them off too. Now, that end is they're tired of being landlords. They're tired of toilets and tenants and everything else. They've been doing it for 20 years. So that's, subject to is secure for both sides. If somebody doesn't know this and they're approached by it, their only recourse is, man, okay, maybe we can get a tenant in there before the auction for a foreclosure lead. Maybe we can get a tenant in there before the auction, and we can help pay off the arrears with the bank with the deposit that the guy's going to give us. You know what I mean? Just think of the mess that can create, right? And really, that's the only position the person would be in if they're trying to rent their house or they're about to go into foreclosure. So, being a landlord isn't really a viable exit when we're talking about sub 2.
For some people, right? Do they have, because not every person should be a landlord, basically. I've had clients that I'm like, you should not be a landlord. She sent this email out to the tenant. I was like, oh my God, I can't believe that you said that to them. But good. Is there anything else that we missed as it relates to subject to? I feel like this was a pretty good overall video and everything was explained excellent on it. What it did come up to my attention is this is not just like subject to. There's this whole world of creative financing. You mentioned land contract. You mentioned lease option. I'm just like, lease option, land contract. I'm like, how are investors utilizing this? So comment below if you want to see Marcus back on the show when this goes live to explain one of those other topics. And is there anything else that we missed? And if somebody is involved in a subject to transaction, I know you helped us with one, how can they get in touch with you as well too? Because obviously I feel like you've been a go-giver from the moment I met you, basically.
I mean, no, I appreciate that. I try to lead like that. I was taught by people that just use their own personal time to teach me. So I try to give forward like that as well. You can reach me directly on my phone, guys. That's the best way is my phone. It's 916-496-4512. Or you can reach me on my email, which is marcus@creativetcservices.com. Either way, we'll reach out. We'll get back to you guys within 24 hours. If you hit my phone, if you text me, I should get back to you within the hour. If it's email, I check my email like 4 times a day.
Well, I want to say thank you, Marcus. On today's episode, we had Marcus with Serve First Realty. We talked about how to buy real estate subject to. We covered what does it mean to buy real estate subject to, pros and cons, who is the ideal seller, who is the ideal buyer, what are some of the risks involved. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful to somebody, make sure to hit that share button, and don't forget to comment if you want Marcus back on the show. Thank you guys so much, and thanks, Marcus, for taking the time.
Thank you, Jose. I appreciate it. Talk to you soon, bud.